Good morning, it's Friday, September 19th, about 6 a.m. Central Time. Overnight, the precious metals continue to rise after Thursday's volatile FOMC hangover. I call it a hangover because traders were eating any market in that fridge to cure what ails them. We saw most asset classes across the board continue to rise and rise aggressively. Now, to give you a quick metals recap, and this is important for people that feel like they're missing out or looking at opportunities to add positions on. Yesterday, we saw gold futures trade about a $45 range before settling up $13. It was below its all-time high at $26.2720. Silver at a $1.40 range and settled up 41 cents at $31.11. Two things I want to note on this. One, the average true range on the gold market, about 1.5 times the average true range. So the average true range on gold being about $32, we trade in a $45 range. Silver, the average true range is about 82 cents, and we traveled in a $1.40 range. So from a volatility standpoint, there seems to be opportunities to add on the downside. And this is the date that you're going to want to really look at potentially adding here. So yesterday's data point reaction, and you want to note this again in your calendar for next week trading. Gold fell $20 over the course of 20 minutes, followed by a lower than expected initial claims data. Remember, the Fed's focus now is on the labor market. So the initial claims data came in at 219,000 jobs. This was below the estimate of 230,000 jobs. The bargain hunters emerged, and shortly after they lifted that market. So if you are a dip buyer, you want to see much lower than expected initial claims data. If you want to see gold futures blast off, you want to see that higher data release. So that could be your next dip buying opportunity next Thursday. Now, looking at the overnight price action of the precious metals and any other kind of commodity standouts here with this heightened volatility, gold achieved a new all-time high, 2640.70. The low on the day, 2608. It's important to note that 2600 seems to be now kind of that floor, kind of that bull bear line. And then if you look from a charting aspect, it's about 2575, which has been this recent higher low on the markets here. So expect dip buyers to emerge unless there's some structural change in the markets. Looking at the silver market here, up 15 cents, 31.59. The high 31.67. That's important to note because it's starting to break out to the upside here. I always thought that there was kind of dead air between 30.54 and 32.50, and it seems we like price momentum we could push up to the 32.50 level. Now looking at the copper market, that was one that if you're working with me closely, we took a bearish stance on. We just had to throw the towel on it. It wasn't breaking down despite the weakness in China, despite the weakness that was expected in the economy. It was the Fed's reversal on stance, and it's lifting all asset classes. And sometimes you got to clear the head. You got to tap out of positions here. That's why position sizing is very important in the markets. You don't want to be all in on any of these things because sometimes they go against your thesis. They go against your, they start to disappoint. And one thing to note that technically copper futures did break out over certain moving averages, making higher highs, making higher lows. And it's just really important. Sometimes you got to clear the slate as a trader and chalk that one up as a loss, but also a learning opportunity here. So looking at platinum, again, focus on January, trading right at $1,000, not really providing any kind of value at that level. Crude oil futures slightly lower. U.S. equities taking a small break here. So the Bank of Japan and China, they held rates steady. Japanese inflation came in line with the estimates. This is really important to watch because the Japanese yen plays an important weighting in the dollar index. Now, the way that I trade and the way that I look at the day here is how the market unfolds. So certain things trigger other things. That's why you want to have a quote board with a bunch of different things. You see the Bank of Japan, they come out and they lower the risk of an October hike with a cautious hold, and you start to see the Japanese yen sell off. Because of the weighting of the Japanese yen, the dollar index starts to rise. When the dollar rises, you start to see some of these treasury yields rise. You'll start to see U.S. equities back off a bit. You'll see gold futures, it could be impacted there, and you might see some of the other commodities take a bit of a breather on that rise of the dollar index. So I would be, if I'm not seeing the breakdown in the gold market, I'll start to keep an eye on things like the agricultural markets that rely on a weaker dollar in order to spur those exports. So couple things here, economic data to watch here today. The Federal Reserve Philadelphia President Patrick Harker is going to speak, which is not a market moving event. However, this is important to note. Next week, a flurry of data is coming out. So again, another opportunity I think will arise on buying some of these different commodities, or perhaps shorting some of these commodities or U.S. equities. So we're going to see PMI, consumer confidence, new home sales, and PMI, that is another inflation data point. Consumer confidence, that could give a gauge as far as where the economy is going, how the consumer feels. New home sales. Thursday is when the fireworks start. GDP, durable goods, initial claims, and then finally the PCE data on Friday. So you could sprinkle in a ton of Fed speakers across next week as well. So addressing why commodities are shifting gears and why I would tap out of something like shorting the copper market is that the Fed policy, it's shifted dovish in that the US dollar tends to cycle lower when you have this type of change in policy shift, and it takes inflation and it reaccelerates it higher, and you get stagflation. So when you get stagflation, things like Bitcoin work, things like the NASDAQ work, some of these other commodities start to take shape, and that the market participants, they also expect the acceleration. So remember, a lot of times it's the rate of change on balance sheets with commodities and things like that. You take something like the sugar market, which was actually one of the best performing commodities this week. You look at the balance sheet of how much sugar's out there, and then you start factoring in, hey, there are fires in South America. India might be concerned about prices, so they might reduce their exports. Now the available supply falls off a cliff with the demand staying constant and prices accelerate. And that's how you get, another 2% move in sugar higher, one of the best performing commodities on the week. So the acceleration towards the terminal rate where the Fed would stop cutting rates at 3.25% to 3.5% could be pulled forward, where we were expecting something like November gets pulled forward to June. So if you look at the CME's Fed Watch tool, it's dancing between another 25 and 50 basis point cut in November, and they're actually factoring about 0.65 basis points cut for till the end of the year. So it's not set in stone for 225s. There could be a 50, and that those deciding factors are going to circle around the employment report. So again, another thing to note, the first Friday of every month, so mark down the October Friday, mark down the November Friday, you're going to get those two, the unemployment report, you'll get the non-farm payroll report, and that's going to determine what Jerome Powell does and how he cuts rates, and that's what plays into the precious metals. Now, a couple things when it comes to the precious metals, I wouldn't necessarily chase this rally in the gold market here, although seasonally we do continue to rise. I would wait for some kind of retest around that 2600 as an opportunity to come back in the market. The silver market does seem to feel like it's getting away, but we got to check the feelings at the door. I put out the tactical ranges on all the different markets here, and if there's a market you'd like to know a range on, I could give that to you. But on the silver market, first major level of support, because of the heightened volatility, it's probably going to be around 31 psychologically, but if we break below that, it's either going to be a shallow dip or we should break down to about 30.67. Again, on the gold market, about 25.95 is your kind of volatility adjusted level of support. And then if you're also feeling like you're missing out on the metals markets, that you want to look at the daily volatility in the markets and then determine a minimum position sizing. So say you have $25,000 in an account, you might want to look at, hey, I'm completely missing it, but a 10-ounce futures contract could be appropriate because gold futures chances are not going to zero. So the complete loss of capital doesn't seem to present itself as a threat. Now, this is a much longer video than expected, but I kind of wanted to clear some of the air on some of the things that I've been thinking this week because of the nature of the volatility and what's been going on here in the market. So any questions, give me a call, 312-858-7303. Have a great weekend. Get them out there. Remember, futures option trading does involve risk of loss. May not be suitable to all investors. Good luck. Good trading.